Hi, this is Alvin, the CEO of Dr. Wealth, and today I'm going to talk about the US stock market is crashing. I usually don't like to talk about market direction because I don't know where is it going. But this time round, the sentiment that I get and based on my analysis, I find that that sentiment of bearishness is strong enough for me to make a call. And I want to give you the analysis, right? So it is not just based on some gut feel that I think the market is crashing. I do have quite a number of stats and data and analysis to back it up. So this is the video that I'm going to share with you all these things that is in my head right now, and see for yourself whether indeed you agree with me that the US stock market is more likely to crash than not. Usual disclaimer, I'm not a financial advisor, and what I'm going to present to you truly as an education purposes or for entertainment if you like it. And definitely do not use it for financial advice. So what do I mean by crash, right? Because different people may have different definition of what does a crash mean. Is it minus 10%? Is it minus 20%? Is it minus 50%? So for me, a crash has to be a minus 50% from the peak to the trough. Okay, so that is the amount that I'm talking about. Minus 10% and 20%, these are just correction. Minor bump on the road. But minus 50% is a crash. Okay, so I'll give you an example. This is the MSCI China, which is the index that tracks the overall Chinese equities, whether they are listed in US, China, or Hong Kong. Right, so this is the index that I find it most representative of China market, and you can see that from the peak to the trough, it has already lost 55% over the span of a year. Right, so the duration usually is around 6 months to 1.5 years, right? So within a year, this Chinese index have gone down 55%. So to me, this is a definition of a crash, right? And now let's look at the US, okay? So S&P 500 from the peak to the trough at the time of recording has been down 15%. Okay, it is not a lot, right? So it's still in like the correction zone, okay? It is not a crash yet, right? But that's why I'm trying to say that it looks like it's going to go to the minus 50%. So that is the consequence that I want to really share with you today in this video itself. And the other one will be NASDAQ 100. So this is more focused on the tech companies, and it has dropped 22%. So it's in the correction zone as well, okay, from the peak to the trough, right? And it make a recent new low, okay, recent new low, and that itself is also a bearish sign, right? So let's then discuss from a technical analysis perspective on these indices. So on my chart, you can see that there's one blue line over here. This is the 50-day moving average, and the red line is the 200-day moving average. Okay, so these are very standard technical indicators you can find on almost any charts, and probably this is also the very first technical indicator that you will learn when you go into technical analysis. Okay, so they are very simple, but they are actually very effective, especially for you to gauge where the general trend is going and whether is it on a bullish or a bearish trend, right? So how do we look at this, right? So the very first sign is that the share price or the index prices have fell below its 200-day moving average. So you can see this region is below the red line. And this itself is the first sign of bearishness, because 200-day is almost like a year of trading days, and the price is below, right? And that signals that the trend is over. That's the first sign. And then the second sign, I write here, there's this death cross. Okay, so what is a death cross? A death cross happens when the 50-day moving average goes below the 200-day moving average. As you can see, the blue line went below the red line. And this also signal a very bearish indication, right, that the market is going to crash. Okay, when you overlay it on a very big index like NASDAQ or S&P 500, right? So the death cross have already occurred in March for NASDAQ, and the third bearish sign is this. Okay, so the index did try to recover, right? But once it hit this 200-day moving average, it went back down again. It became a very strong resistance over here, and then it make a new low, right? So this is like the fourth bearish sign from a technical perspective. NASDAQ already have 4 of them, and it shows that it is more likely that the market will go down more than it goes up at this point in time. Okay, although it can change, okay, which we will talk about that a bit more later, right? But at this point in time, we can see that these technical indicators show us that it's more bearish than bullish. And let's go back to the S&P 500. It is the same thing that we see over here, right? The first thing that happened where we can see is that the prices did gone below the 200-day moving average, and then after that it bounced back up, it went back down again, and it tried another time, it refused to break the previous high, and it went back down this 200-day moving average, right? So this is another bearish sign over here, and then the third one will be this death cross, which also happened in March. Okay, so for S&P 500, you have 3, right? It didn't make the new low, okay, but there is a possibility that you will create a new low after this video, right? For all you know. Okay, so there's 3 signs, and same thing, this S&P 500 is bearish as well, right? But there is a difference, right? S&P 500 doesn't look as bearish as NASDAQ. Okay, one of the key reasons is because NASDAQ is very tech focused, and we know that now is the rising interest rate environment, and it's very bad for growth stocks because the discounting of future value to today's value is going to be much higher than it was before. And S&P 500, on the other hand, is a broader index that covers many sectors in industry, not just the tech. And one of which is the commodities, which includes oil and gas, agriculture, right? So these are the sectors that are doing well in a higher inflation environment. Okay, so that's why S&P 500 looks more cushioned in terms of its drop compared to NASDAQ. So that is the key reason why there is this disparity between these two indices, although both come from the US. Okay, so as I said, it is likely that these prices are going to go down, the indices are going to go down, and I think that these are precursors to a major crash, which is the 50% drop that I'm talking about. It can even go to 60%, 70% from the highs. Okay, I don't know where exactly it will end, but it just looked bearish to me, right? All these technical indicators. But of course, we can also look at more from a fundamental perspective, and let's look at other indicators, okay, from a fundamental analysis angle. The very first one that I want to share with you is this Buffett indicator. So of course it came from Warren Buffett, and he was suggesting something like this, right? You always compare the market cap to the GDP of the country, and then you will see which is are they fairly valued, right? So market cap is all the individual companies' market capitalization add together, right, into form one big market cap for the entire stock market, okay? Or it can be just the index itself, right? For example, a broad index like S&P 500, then you compare it to the GDP of the US, and you want the price to be similar to the value, right? Then it's considered fairly valued. If one overshoot the other, if the market cap is much way ahead of the GDP, then it shows that it is overvalued. So that is how the Buffett indicator came about. That is his rough sense whether the market is overvalued or undervalued. And let's look at the indicator now. Okay, so this black line over here is the fair price, right, or the average price that it should trade at. Okay, if it's at the black line, means that the price and the value are similar. Okay, and if this number goes up, it means that the market cap is higher than GDP. If this graph goes down, it shows you that the market cap is below the GDP. So anything below the black line is considered cheap. Anything above the black line is considered expensive. And if you remember your statistics class, if this is the average, you will have one standard deviation here and a second standard deviation over here. So you just measure how far does it deviate away from the average. So right now we are in between one standard deviation plus one standard deviation and plus two standard deviation, and which is overvalued side rather than undervalued side. And this also shows that from fundamental perspective, the stock market in the US is overvalued at this point in time. Okay, next one, PE ratio. This is something that you will understand a lot more readily compared to the Buffett indicator, right? So this PE ratio is again an amalgamation of all the index component in S&P 500, all their PE ratios add together, divide by the weightage that is in the S&P 500, and then you get overall PE ratio for the index itself. So as we know, if high PE is expensive, low PE is cheap. Okay, so again, there is an average PE that the market trades at, which is indicated by this black line over here. And if this graph is above this average black line, means that it's overvalued, and if it's below, then it's undervalued. And we can see, similar to the Buffett indicator, it is near the +2 standard deviation, right? It's 2 standard deviation away from the average. And this also suggests that the PE ratio for the index components are on the higher side as well. So whether is it the Buffett indicator or the market PE, from a fundamental perspective, they are overvalued. Okay, technical analysis, just now we saw, they were bearish as well, right? So these are the indication. Now we haven't talked about what are some of the reasons that caused this to happen. The last one that I want to share with you, the indicator, is the yield curve inversion. This is more related to the economy, right? If the yield curve inverts, okay, that means that an economic recession is looming. It doesn't mean that the stock market is going to crash, right? Although there is relationship that the stock market usually precedes an economic recession as well. The stock market will crash first before the economic recession comes. Okay, so it has some relation, right? This yield curve inversion. And what this yield curve inversion means is that it compares the 2-year bond and the 10-year bond of the US government treasury. Okay, and by right, the 10-year bond should trade at a much higher yield compared to the 2-year, because 10 years you should be compensated with more returns because you take more risk as compared to just a span of 2 years, right? So a normal yield is that the 10-year is higher than the 2-year. But a yield curve inversion happens when the 2-year yield is higher than the 10-year yield, right? So it flips the other side. And when that happens, usually the economic recession will happen within an average of 18 months. Okay, and the most recent inversion has happened in April 2022. Okay, and the previous one was 2019, and indeed it was true. 2020 was COVID-19 and it caused an economic recession, even though it was very short-lived, but it did cause GDP to contract during that year itself. And then now it inverts again. Okay, which means in the next 18 months, there is a possibility of a recession. And if the stock market, okay, if indeed this stock market is going to crash, okay, 50% and then crash 50%, right, it also means that the stock market is likely to precede an economic recession, right? Because the stock market leads the economy. And if you have seen this, then likely the economic recession happening, the chance of it happening is very, very high. Okay, so these are some of the indicators. If you add them together, they all suggest one thing, that the market is going to go down, right? And are these indicators 100%, right? Definitely they are not, okay? No indicators are 100% because markets can reverse, okay? There have been cases where in the past, certain indicators were signaling whether it's the overvaluation, a crash is coming, but it could reverse, and it did reverse before. And the only issue right now is that you usually need a sudden change in the sentiment. You need very good news and the bad news to go away, right? You need the good news to come in and the bad news to go away. Otherwise, it is difficult for the market to reverse at this point in time. Of course, now let's talk about what are some of the issues that are weighing down the market, right? These are the bad news. If they don't go away, it is unlikely that the market can recover from where it is. It is going to be more bearish than bullish. All right, so the very first one is the Russia-Ukraine war, which is still ongoing. We expected, most people expected it to end earlier, right? Probably within the first 2 weeks, but it didn't, right? It dragged on for more than a month. Okay, I'll give you more details later. Then the second one is about the China COVID issue, right? And the potential economic slowdown in China. Because China is a major trading partner to a lot of countries around the world, right? It is essentially the factory of the world. And anything that affects China, right, and it slow down its economy, it will cascade to the rest of the world. And that's what globalization means, right? And then the last one is inflation, okay, which is also linked to point 1 and 2 actually, right? But even without 1 and 2, inflation was already here, which we will dive deeper into what this issue is all about, right? So these are the 3 major issues that are ongoing right now at the time of recording, and they are weighing down the stock market very much, okay? So let's look at it one by one. The very first issue, Russia-Ukraine. The war doesn't seem to end anytime soon, and Ukraine has been holding off Russia pretty well, and probably thanks to the West, the Western Bloc. They have supplied Ukraine in terms of cash, in terms of military equipment, and that helped Ukraine restrict the Russian invasion. Right? Russia did conquer some lands, but the progress is very slow. right? So it doesn't seem like this war is going to end anytime soon. The second one is that many US companies have pulled out of Russia, and that hurt their financial results, right? For example, Netflix have pulled out of Russia, and their subscriber count has dropped significantly, such that it was the first time they report negative growth rate, right? They lost 200,000 subscribers. Okay, so one of the key reasons was that they pulled out of Russian market. Although there are some other reasons they raised the prices, right? But one of the key one was that they pulled out of Russia. So some of this impact has caused the company's results to be less than expectations, right? And Google, which is the subsidiary of Alphabet, have also released their results lately, and their growth has slowed down because they also lost some of this revenue from Russia, right? The advertising revenue from Russia. So you can see that even though US company they have operations around the world, right? And Russia is just one of the many, okay? But the pulling out of Russia does have impact to their fundamentals, okay? And if the fundamentals are not as rosy as before, that's why their share price will have a ceiling how much they can progress, right? In fact, some may even correct, okay? Like Netflix dropped a lot, okay? Dropped like 30% overnight, okay? So these are the impact to some companies. And then the third one is sanctions will hurt trade. Countries like to have more trade, and companies like to have more trade, right? Because if there is more transactions, there's more revenue to be made, there's more growth to be captured. So sanctions generally also take away some business off the table, right? So some companies will get hurt more than the others, depending on the exposure to Russia itself. And then the fourth one is the commodity supply will be affected because both Russia and Ukraine export quite a number of commodities to the rest of the world. So Russia will be oil and gas, and Ukraine will be some of the soft commodities, right, like corn, wheat, and things like this. And even fertilizers, right? They make a lot of fertilizers, both of them, and that caused the rest of the crop prices to go up because fertilizers are needed for all the crops. So it comes one big circle back to where it is. And all this will cause the inflation to worsen because even before the war, the inflation issues have already been ongoing, right? But this war will cause the supply to get squeezed even more, and that's why prices will go up. And if this war doesn't end anytime soon, it also suggests to you that the commodity prices are not going to come down anytime soon, and that would support that inflation going forward, right? Which is not a good thing. Okay, so this is issue number one, right? That is weighing down the market. Issue number two is about China and the neighbor of Russia, right? And they are very insistent on the zero COVID policy. And while the rest of the world are opening up, China is closing down. They are locking down the cities, and we are talking about key cities like Beijing, like Shanghai, and Shenzhen momentarily also had their lockdown, right? So this lockdown is hurting their economic growth because China have already projected a lower economic growth target in 2022 at 5.5%. And last year, it actually did 6%, right? So already this expectation has been lowered. And now with all this lockdown, a lot of analysts and economists were very pessimistic whether China can really hit this 5.5% growth in 2022, right? And we don't know how long this lockdown will extend to, right? It has been ongoing for weeks, and it can spread to the rest of China because we know that Omicron is a very, very contagious version of the variant of the coronavirus, and China is a very populous place. It can spread very fast to the rest of the 1.4 billion kind of population. You don't know how extensive the lockdown is going to be. If the whole China lockdown, the rest of the world is going to suffer as well because China is the factory of the world. They make a lot of things and they export it out. And without China producing all these things, who are going to produce these things, right? Because the lockdown will have prevented people from operating the factories. Even their logistics have problem delivering food to the people who are under quarantine, right? So this lockdown is going to halt the economic growth that China so much desire after the COVID first struck in 2020. All right. So that is still an unknown, and it will cascade to supply chain problems for the rest of the world, right? That's the price of globalization. Everything is connected, and this, if supply chain becomes a problem, is going to raise price further, right? And that's going to hurt that inflation issue. That's why I say issue 1 and 2, when you sum up together, it will end up in issue number 3, right? Now we come to issue number 3, which is inflation. So US inflation has hit a high of 8.5%. And this inflation problem came about in 2021, but in those days, the Federal Reserve felt that it was a transitory inflation because they opined that due to the COVID lockdown, the supply chain got affected, and then when the recovery came, the demand came back much faster than the supply, so there was a supply shock, and that's why the prices shot up and the inflation goes up. But then the tone changed at the end of 2021, and they dropped the term in transitory, and then inflation become the number one enemy of the Federal Reserve. And now at 8.5% inflation rate, it is the highest in about 40 years, right? So it is a problem that they're going to deal with. And as I said, issue number 1 and number 2 have add on to this inflation problem, right? Because the supply chain may get shocked again in China due to the lockdown, and then in Russia, because of the war over there, they export a lot of all these commodities together with Ukraine, and with the drop in the supply to the rest of the world, again, the prices are going to shoot up further. So all this inflation problem doesn't seem to be able to go away, and the Federal Reserve now are trying to raise interest rate, right? So let's go through in more detail what this inflation problem is all about. The interest rate has been low for a long time, okay? And you can see even starting from the 70s, there was a high inflation rate then, and the interest rate went as high as 20%, right? So that's almost unheard of today. Today, we are talking about close to zero, and it started this zero interest rate or close to zero since 2008, which was the great financial crisis, right? So that was then Federal Reserve Chairman was Ben Bernanke. He studied a lot about the Great Depression in the 1920s. And he felt that the only way to prevent the mistakes from happening, a very prolonged or protracted recession, is to quickly flood the market with liquidity. And that's where he experimented with the QE, or quantitative easing. That means print more money and then buy assets. So you flood the market with that liquidity. All right, so that was how it began, and coupled with low interest rate environment, it was very favorable for the stock market in the US. Okay, and then around the 17 period, there was a rate hikes. Okay, but it wasn't very high increase in interest rate. In fact, you can see the overall trend for the US interest rate is on a downward, and we are looking at this period is a 50 years history. It is not short. So over the span of 50 years, the interest rate has been falling, and for the good part of the 13 years, it has been close to zero. And with COVID, they further do another QE. It was like QE4 already in COVID, and they went to purchase more, and the stock market really rallied, right, in 2020, 2021. Those were the good days. And then now, with the inflation coming in, they need to increase the interest rate. And that caused the entire stock market to be out of whack, right? Because interest rate is a very critical element when valuing a growth stock, right? Because the growth stock value is in the future. Okay, future value is what is the valuable part of growth stock. And then you have the present day value. Okay, so present day value is a discounting of the future value, and the discounting has to do with the interest rate. If the interest rate is high, then the discounting is small. Okay, and that's why a lot of all these stocks get whacked. The higher growth stocks get whacked more than the lower growth stock, is because they are relying on the future value that has now been suffering a heavier discount when looking at their present day value. Okay, so that is why this interest rate became very important. Okay, so the markets have been enjoying this low interest rate environment for the last 13 years, coupled with QE 1, 2, 3, 4 that flooded the market with liquidity, right? So that is one of the conditions that laid out for inflation to happen, because there's just too much liquidity out there in the markets. In the last 13 years, inflation was not a problem, so they went ahead with low interest rate, and then they went ahead with QE 1, 2, 3, 4, right? Because inflation didn't happen for 13 years until now. So what it happens is because of COVID, okay, supply shock, right? So coupled with a lot of liquidity, a lot of money chasing not enough goods, and that's why prices shoot up. Okay, so without COVID, maybe this QE game can continue. But too bad, COVID happened, supply shock happened, inflation now is in forefront of the play. And this is a pictorial example on why the interest rate will affect valuation. So just remember in your mind, right? It looks something like this. Okay, you have high tide and low tide, right? So we look at the valuation as the tide. So during low interest rate environment, the valuation tide goes up. Okay, such that because more money is chasing the same amount of stocks, right? It pushes up the valuation. People are willing to pay a higher valuation for the same kind of stock. But now interest rate is going the other direction, then your valuation tide comes down. Okay, less liquidity flowing around, less money chasing after the same stock, then people are become more prudent, right? I'm not going to pay that kind of sky high valuation in the past. I'm going to pay much lower. And that's not just happening in the public market, but also in the private market. Startups are getting harder to find funding, right? And the valuations are lower as well if they manage to find funding. So interest rate have a very big impact to how companies are being valued, especially the growth stocks. As I said just now, due to the fact that the future value get discounted more to today's value. Okay. And the other part of it is that the liquidity, right? Interest rate is just one part of the equation, but the quantitative easing started in 2008. As you can see, the big jump by Ben Bernanke. They did many QEs along the way, right? They started with buying more bonds, okay? And then they also started to buy the mortgage-backed securities, which is one of the big issue in the 2008 financial crisis, right? Because a lot of the banks were dealing with this packaging mortgages into securities and then selling them to investors. So the housing market crashed, and so gone with these MBS, mortgage-backed securities. And the Fed has to be like the buyer of last resort to support the market. They bought in a lot of all this, right? They printed money and bought. And even in 2020, they experimented with something new. They started to buy ETFs as well, right? So the whole balance sheet of the Federal Reserve end up with a lot of different kind of assets, okay? And now they need to unwind them, right? And this is the forecast from JP Morgan. They expect to unwind a significant percentage of it over the next few years. Okay, you can see that the asset has ballooned in the Federal Reserve balance sheet due to QE 1, 2, 3, 4. Right, so there's a lot of liquidity in the market, and removing this liquidity is the principle is that you remove the liquidity, the tide will fall, and the valuation will fall as well. Right, less money chasing the same amount of stocks. Okay, so that is the idea of this quantitative easing that's causing the market a lot of problems as well. Right, so now you realize that the US market fundamentally, due to the Federal Reserve action, will cause systematic kind of changes to the entire stock market landscape. The valuation will change a lot, liquidity will reduce a lot, right? So that's why don't belittle this inflation problem that the Federal Reserve is trying to deal with. They're trying to reduce liquidity, they're trying to increase interest rate. Okay, that will change the entire valuation in the stock market. And over the years, last 13 years, US stock market is one of the best performers, right? We're talking about over a span of 14 years, 262% return, okay? US market, right? The gray parts are the parts where US market did better than the rest of the world, right? Compared to EAFE, the Europe, Australasia, and Far East, okay? The developed markets only, all right? But US market doesn't always outperform. As you can see, the purple one is where the rest of the world outperform. Okay, and it seems like you see alternates. So what I'm trying to say is that even though the rest of the world, the markets have been very bad for the last few years, especially China, right? Europe also pale in comparison compared to the US. A lot of all these stock market boom, I would attribute it to the QE and the lowest interest rate environment. Right, is boosted by it. Of course, there are fundamental reasons. US still have very good companies over there, but the fundamental reasons alone are not enough. It is due to the liquidity, the massive liquidity that's been pumped inside, and the super low interest rate that we have been experiencing in the US that saw this super bull run. That really is one of the best bull runs, as you can see, compared to history. Right, this is unusual. Right, which also mean that if this liquidity and the interest rate going back to normal, right, may cause this crash to be even heavier than ever before, right? So that is why I'm saying that this crash of 50% is very likely. Okay, in fact, I think can be even more, 60% down, 70% down, or even 80% down, right? If, of course, it's contingent to how much liquidity is being removed by the Federal Reserve, how much of the interest rate is going to go up. So if this inflation gets out of hand, interest rate will go up faster, QE will get removed faster, right? And then that will cause the crash to be more painful. So it is a reaction to the inflation that the Federal Reserve actions are going to match with, right? So that alone, inflation is one of the key, if not the key issue that I think will cause this market to crash, right? And as I said, US market is not always the best performing ones, okay? Just that the recent years, you can see this is a rolling 10-year return from S&P 500, CSI 300. I didn't manage to get enough data. These are just capital gain, excluding dividends, and also compared to Singapore market, a smaller one, and to show you the relative 10-year returns, right? Every year is the past 10 years return. So you can see that actually US didn't do well for 10 years leading to 2109, 10 years leading to 2110, 10 years leading to 2011. So if you buy S&P 500 in 1999 and you hold until 2009, you actually lose money. Over a 10-year period, you actually lose money. Okay, so same thing for the next 2 years. All right, so every index you can see, or every country will have periods of underperformance, and it will periods of outperformance, right? So it is not always the same, right? They almost like take turn. Okay, what I'm trying to say here is that US have a lot to crash, basically, because of the seemingly very good years that precede what we have experienced so far, right? And that means that the tide might turn. The rest of the world might do better in the next 10 years or so, okay? Then the next thing is that where to put your money, right? The question is that if let's say US is really going to crash, right? Where can you put your money if you're very heavily invested in US? And a lot of other markets have already crashed. Just now at the start, I will show you that China market is already down 55%. It has already crashed, right? Past my definition of the 50% crash. And if you are invested in China, it doesn't matter because you're already cheap already, right? Shifting your money elsewhere is the same probably, right? If US crash, you shift your money from a crash market in China to US, there's not much difference to it. Let's look at other markets, right? So let's say you talk about crypto, okay? Unfortunately, crypto also crashed. Okay, I'll show you more details later. How about cash, right? Cash is king. During a recession, during a market crash, you can buy more. Is that true during a high inflation era? We discovered that as well. Commodities, right? Commodities have been doing well. Is it wise to shift your money from, say, tech stocks to commodity stock at this point in time? And lastly, how about bonds, right? Bonds are known to go up as stock market goes down, right? Is this still true in this environment? So let's run through one by one. And when we talk about crypto, definitely Bitcoin is the poster boy, right? It's the most important crypto among all. And some people were saying that, oh, cryptocurrency, because it's outside the very loose monetary policy, outside the monetary system, you're not harmed by the inflationary kind of pressure that the dollar is facing. Okay, so naturally it should be a hedge against inflation. But unfortunately, what we have seen so far in terms of the price action of Bitcoin, it doesn't say that. Okay, because as inflation go up, Bitcoin actually went down. So Bitcoin or crypto in general is not a hedge against inflation. It proved, at least in the recent episode, that it isn't. And Bitcoin has crashed more than 52%. Okay, from the peak to the trough, right? That's 52%. Again, fits my criteria of a crash. Okay, if you don't know already, the cryptocurrency world has already crashed and it hasn't recovered yet, right? So is it a good place to park? Okay, I don't know. Okay, it has already crashed, and if we say that it's not good for inflation, if inflation worsen, it doesn't seem like crypto is going to go anywhere either, right? How about the other two C, cash and commodities? As you know, if inflation is high, your cash will lose purchasing power very fast, right? Your bank interest rate is not going to catch up with inflation. And if the inflation is hyperinflation, in the teens or even in 20%, if you can't get the interest from the bank at 10 plus 20% interest rate, right, then you're going to lose purchasing power very, very fast. Okay, so again, too much cash in the bank may not be a good idea, even if the market is crashing. And how about commodities? Remember, commodities are cyclical. Alright, yes, we don't know how long this commodity run is going to go. Is it 1 year, 2 years, 3 years? But eventually these commodity prices will come down because commodities are known to have cycles, the boom and the bust. And each boom and each bust can last for years. Sometimes it may not last so long, it may be very short-lived, but it can be very long as well, right? So the fear is that the boom this time very short-lived, and then it crashes, and then the recovery are years. Okay, so you don't take that risk with commodities. Commodities are not meant for long-term investing. If you're talking about short-term investing into commodities using certain momentum strategies, I think they are fine, right? But they are not meant to be held forever. They are not meant to be held even for years, because you never know when the cycle is going to turn down. So commodities also don't make a very good alternative investments to switch out your stocks. Okay. Then lastly, bonds, right? Bonds have actually corrected as well. Okay, some I would say even crash. For bonds to go down so much, right? You could talk about 20-year bond has went 32% down from peak to trough. 10 to 20 year has 27%. And you look at 1 to 3 year, 4% is not a lot, right? But the yield is almost zero and you lose 4%, and it's supposed to be what? Safe, right? Bonds are supposed to be safe, but has been losing money, peak to trough. Okay, so bonds are not that safe because what's happening is this, because they move opposite to interest rate. If interest rate goes up, bond prices goes down. Okay, because the newer bonds have higher interest rate, then the older bonds with lower interest rate has to be sold cheaper, okay, to match with the new interest rate, right? So bonds are not as good in a high interest rate, or not say high interest rate, a growing interest rate, rising interest rate environment, because the bond price will continue to fall. Okay, so a lot of the modern portfolio theory, right, will say this. Okay, you hear this a lot, right? Have stocks and bonds. You want to diversify different asset class, right? Because why? Stock and bonds don't go hand in hand together. If stock goes up, bonds go down. If stock goes down, bond goes up. Okay, but I already show you that it's actually not true, right? The bonds are not as safe as what it is today. And later I'll show you another a slide on that. Okay, the correlation between the stock and bonds is has become more correlated than not correlated. Okay, so the modern portfolio theory is something that the advisors, financial advisory, has been using for the past 50 years. And whether is it robo advisory or non-robo advisory, this is usually what they say. They have 3 types, the 3 main types. Sometimes they have 5 types, but they are the same, right? So if you are more risk averse, they'll say that, okay, you put less to stocks, more to bonds. If you are moderate risk, you put some to bonds, some to stocks, more even, close to 50-50. And then if you're aggressive, we put less to bonds, we put more to stocks. Okay, so this advice, or this very cookie cutter templated financial advice, has not changed for the last 50 years. Even with robo advisor, it is still the same. And why I want to bring this up is because this asset allocation will not help you in this environment, because okay, they are correlated. Now, because of the interest rate going up, that is the context that is driving the correlation. So if you have bought this diversified portfolio, so-called, you actually lose money, right? Why? Year to date, you look at the index, the stock index, it has gone down 13%. And then if you diversify into the long-term bonds in US, it's down 15%. Okay, where is the protection? There isn't. So overall, the portfolio is down 14% if you do a 50-50 split between the stock and the bonds, right? So which means that even this modern portfolio theory, this concept of asset allocation is out of whack, right? Because the Federal Reserve has just changed the entire landscape due to the low interest rate environment and the QE that has been done for the last 13 years. And then now they are going to unwind. It has been driving the asset pricing out of whack as well. Okay, so this modern portfolio theory is not going to save you either. Okay, so it seems like it's very dire and very pessimistic, but don't get despaired. Okay, as an investor, you must be optimistic. even if the market is pessimistic. You must be optimistic, because that's the only thing that the investor will invest in, right? Because you believe that the future is going to be better than what it is today. That's why you invest. If you are pessimistic, you will not do anything. So my view is that the stocks are still the best place to park your money for long-term growth, right? So I did share a lot of the assets. They are not the solution to your worry in the stock market. Okay, stock market remains the best place to park majority of money. I'm not saying that these other assets you can't invest them. Okay, you should, you can, just that I think the big bulk of the money should still be in stocks. Okay, it's still the best place, even though I talk about it might be crashing, right? And how do you handle that? Okay, if you know that it's going to crash and yet you have to invest in stocks, how do you do it? And some people have already invested more. Some people still have a lot of cash trying to deploy in the downtrending market. Okay, so it depends on your context, right? I have done another video. I shared 10 ways to handle a stock market crash. I did that in January, and that was when the stock market in the US started to go down, right? And same thing, I don't know whether it was a crash or not. It looks like, but it didn't crash all the way down. It got stabilized, some rebound, but then now it's lower than where it was in January, right? So now there's this refresh fear that the market crash will come. So this is even more relevant today than it was in January, right? I'll put the link in the description below so you can conveniently move on to the next video, right? Since I talked to you about potential crash in the US market, if you're worried about that and you don't know what to do, this is the video to watch. Okay, so I'll see you in the next video, and remember to like this video as well as to subscribe to the channel. Okay, if you don't like, never mind, remember to subscribe to the channel so that you will not miss another good video in the future. I'll do more market analysis, I'll do stock analysis, whatever that can help you to improve your investment journey. So hope to see you around, and remember to watch this next video. It will definitely help you and know what to do in this market crash if indeed it's going to come. Cheers.